All right, everyone, welcome back to the channel. So today's topic is going to be projection theory, looking at market maker swing grids and also measuring gaps. So before we hop into a chart to actually look at this in real time or using some historic data, let's first look at this general schematic. I will break down these concepts in context of last Friday's price action after, but we first need to understand some of the topics that we're talking about. So the first topic we're going to be discussing today is swing grades. Now, swing grades are equivalent to an implied dealing range of a market maker model. An implied dealing range is four quartiles between the area of smart money reversal in a market maker model and the suggested or assumed terminus of that buy or sell model. As you can see on the left here, we have a market maker buy model with the 0 and the 1 aligning to both the smart money reversal and the assumed terminus or external range liquidity. In between, we have the 0.75, the equilibrium, and the 0.25 quartiles or swing grades, which we're going to be using for our analysis. And we're going to be looking at different internal dynamics of price in between each of these levels. Some people think of this as an implied dealing range. You can also just call it a swing grade. They mean the same thing. Okay, in addition to that, we're also going to be looking at something called measuring gaps. Now, measuring gaps are something that we can expect in a certain region of this swing grade or implied dealing range, and that's why we're also going to have to expand on that topic as well. So without any further ado, let's take a look at our market maker swing grades or our implied dealing range and touch on what we expect to see at each level. So as we've spoken earlier about, at the 0 level, what we expect to see is our smart money reversal. So that's where we're going to be anchoring our first, Fibonacci from. At the 0 to 0.25 level, that is where we expect to find our low risk buy or our low risk sell. So this is the area of the chart where in a market maker model, we expect to get that entry. Say we tag internal, we get a smart money reversal. In between this 0 to 0.25 or 25% of this range, we expect to see our low risk buy. Now, in between the 0.25 and the 50% mark or the equilibrium, what we can expect to see is one of several things. Either a consolidation in the market, a breakaway gap or measuring gap, or a high probability order block. Often there's a combination of several of these things. So let's quickly touch on what a breakaway gap is. For the purpose of this lecture, we will refer to a breakaway gap as an imbalance that rebalances only a shallow portion of that gap. So what we could think about a breakaway gap to be is a imbalance, like a BISI, that is only tagged above the 50% or equilibrium consequent encroachment of that gap. If it goes down lower, then we wouldn't call it a breakaway or a measuring gap. In fact, I would actually call a measuring gap, a gap that's rebalanced shallowly, and a breakaway gap, a gap that isn't engaged whatsoever, meaning that the gap itself is never touched. So both of these concepts can be applied inside of this 0.25 to 0.5 area. With respect to a high probability order block, on my Twitter, you have seen examples of what I label to be high probability order blocks. So go into there after and find that concept if it's not clear already. So now, between the 0.5 and 0.75, what we can expect to see is the formation of our low resistance liquidity run into our terminus, that is the end point of the implied dealing range, which in this case, external liquidity in a market maker buy model from internal to external would rest below. So in this area, we can use concepts like the silver bullet or second phase reaccumulation to frame that high velocity and large displacement move that rips into our target between the 0.75 and the 1 swing grades or the implied dealing range area. So as we see on this schematic here, we can also apply the concept of regular standard deviation projections and look for reaccumulation in expectation, right, with these swing grades. So for example, we might get our first stage reaccumulation inside of a measuring gap from the 1 to 1.5 standard deviation. And then we may get our silver bullet, right, or our second phase reaccumulation into our low resistance liquidity run in between the 0.5 and 0.75 area. These are nice confluences to layer onto each other when we're looking at projection theory or measuring theory. Okay, the last thing I'll say before we hop into a chart is that generally speaking, a question I get asked often is, fees, how do you know if price is going to actually reach the terminus of this model, or is it going to reverse? And a general rule of thumb that's taken from an ICT Twitter space is that if price displaces through the equilibrium or 50% portion of this implied dealing range or this swing grade, we are more than likely to reach the original consolidation, and we are more likely to do that than we are to reverse. So that was a piece of information that ICT dropped, and that's what I regularly look for to see if we are displacing the equilibrium of this implied dealing range, or if we are rejecting this equilibrium, or simply lacking displacement through it. Okay, so now that we understand some of these concepts, right, let's get into a chart and kind of look at how we can use these swing grades and measuring gap theory in combination using a real walkthrough of price action on Friday. So here I have a blank chart of last Friday's price action. And the first thing we want to do is approach this from a top-down perspective going into the day. So as we notice on the daily chart, you can see, I'm going to get rid of this indicator in here that shows my weekly separators. Here we go. Okay, as you can see, coming into the day, we had previously displaced this candle low, and we had left relative equal lows, right? We had displaced this low here and this low here, and we had left relative equal lows. So we can assume that the next day, right, which is Friday, is going to draw into this sell side liquidity as a greater part of this market maker sell model that we are seeing on the daily chart, right? And this market maker sell model has been occurring for a while now, so we can use, a regular projection like this to, monitor some key levels in here. Now, given the bearish price action I'm observing, I can say that my draw on liquidity for this day is going to be this internal range fair value gap, or potentially even this down close candle, which is a bullish order block, right? So I can put this as an OB on the daily. Now that I have my points of interest marked out for the day, let's reduce our time frame and zoom in to the lower time frames and see what price does, throughout the day. So as you can see, during the Asian session, we come down below this level and we get a reaction off of this daily fair value gap and this order block we had marked out, this one right here, right, in the London session. Now, as the London session and the Asian session push up and displace, we can actually see that at some point in time, we get a reversal of order flow. And this reversal of order flow, like I talked about in my recent Twitter post, is because we form a smart money technique divergence up here, which we can label as an SMT, and this is with the Dow, right? If we pull up a Dow chart, you'll be able to see that this is the SMT that we form at the previous day high, or not at the previous day high, rather, at this previous session high, the PM session high, and that divergence is right in here between this New York high and this high there. So that's our smart money technique. So that's our first criteria for a reversal. And then in addition, we have our higher time frame array, which is going to be, this hourly high or 4-hour high, depending on what time frame you look at it. Now, the purpose of this lecture isn't to talk about where we expect reversals. That's an IPTA market cycles lecture. But let's now zoom in to this hourly market maker sell model. So looking at this hourly market maker sell model, you can see that we now get a market structure shift below this low. So we can mark that out. And this happens in the AM session when we start to displace lower and we start to violate old PD arrays, right? We have this bullish fair value gap that we trade and displace through, creating a new balanced price range as we print this bearish fair value gap on top. And then in addition, we get another displacement below this bullish fair value gap, right, coming into the PM session. So now in the PM session, I have my bias, which is going to be delivery into sell side liquidity. As you can see, this sell side liquidity in here is the target or our draw on liquidity. So I will mark that out with this blue line. Get rid of this. And moving into the PM session, you can see we have a very nice overlapping set of PD arrays. We have this hourly SIBI. I'm going to get rid of this daily fair value gap as well in this, just so we can clean up our charts a bit. Right, this hourly SIBI overlaps this inversion fair value gap. So we know we have PD arrays that are going to support price lower. So now, once we zoom in to the 5 minute, right, once we come back in the PM session and we retrace this internal range fair value gap, what we can do is we can frame, right, this last distribution leg of this 5 minute market maker sell model. And what we actually want to do is frame this in context of the entirety of this market maker sell model that occurred throughout the day. So on my Twitter, you'll see I've annotated it, and I'll link that below in the description so you can actually go look at the chart and see how I annotated it. But this was the trade I actually engaged in, which is going to be the second phase distribution of this market maker sell model, or the formation of this silver bullet, right? So we have our smart money reversal, our low risk sell, our first reaccumulation inside of, right, inside of this inversion fair value gap, and then we have our second phase reaccumulation and redistribution, right? And therefore we expect to see some form of SMT as well right here, which again, we can confirm actually does happen when Dow liquidates, the highs, because Dow and the NASDAQ had extreme divergence all day, right? So now we have our condition for this second phase distribution lower in this market maker sell model, which is going to be our SMT inside of our hourly gap, which I will mark out with this red box. So let's now bring together, now that we've done our top-down analysis, right? Framing this 5 minute market maker sell model from hourly, external, or internal rather, to external, my apologies. So this is going to be our sell model, right? And again, just to make it very clear, the PD array we are reversing from is this hourly SIBI with SMT, so it's the characteristic for a reversal, right? And now we're framing this sell model on the 5 minute. So let's make sure that we understand exactly what the dynamics are our sell model, and let's use the theories that we talked about from this schematic. So let's start off by using our swing grades. So in our swing grades, what we want to do is anchor our Fibonacci, right, or our implied dealing range, from the smart money reversal to the implied terminus. It's going to be this slow. Now what I will do is I will collapse these and I will actually put them on the right hand side and make sure it lines up, and then do this. Okay, so now we have our swing grade levels mapped out. And what we are going to do is also try and pair them up with the expected, right, internal dynamics. So as we can see, from the 0 to 0.25, we expect to see our low risk sell. Well, in here, after we get our smart money reversal, we have this internal range that acts as our low risk sell. This is a very small inefficiency on the 5 minute chart, but it still is an inefficiency, right? If we zoom in, you'll see there's still a 5 minute fair value gap in there. More importantly, right, what we expect to see at this low risk sell in between these two areas, which I will annotate here as the low risk sell region. Let's get rid of this background as well. Right? Is an SMT. That's going to confirm that this manipulation higher is leading to our, short-term reversal, right? Retracement is a short-term reversal. And as we can see, we actually do form SMT right here with the ES. So this was a very telling sign, right? That this was going to be the high that was formed inside of this fair value gap. So it would be an intermediate term high. Remember, ES creates this higher high up here, which means that we have let me grab an arrow. ES forms a intermediate term high right here with a shorter term high to the left and a shorter term high eventually forming to the right. Now NASDAQ forms the SMT, so we can also assume that this is going to be our intermediate term high by nature of that SMT. And let's pull up our ES chart just to confirm that this is accurate. And this is why intermarket analysis is so vital when we're doing kind of our top down, or when we're approaching trades for the day. We want to see these dynamics and these signatures because it's telling us a story about algorithmic price delivery, right? So this SMT in here that forms is now creating an intermediate term high, like we just spoke about on the ES, right? We're creating the intermediate term high up here. And then NASDAQ has an implied intermediate term high, or what I like to call a pseudo intermediate term high, because the SMT forms. So we have a higher time frame SMT with the YM, and then this lower time frame SMT that forms inside of our low risk sell inefficiency. Now, in between the 0.25 and 0.5, the expectation is to see consolidation, a breakaway gap, or a measuring gap, or a high probability order block. So as you can see, in this area on the 5-minute chart, we are seeing this large distribution, right, lower. We're seeing these consecutive down close candles. I know when I see consecutive down close candles, that equates to a fair value gap, right, on a higher time frame. So I will use time frame alignment and shift up a time frame back to the hourly with the expectation of framing a breakaway gap in this area or a measuring gap. As you can see, we now form this breakaway gap, which we can label BAG. Now, this breakaway gap is exactly the expectation that we have, right? Although it doesn't look like a breakaway gap on the 5-minute, this breakaway gap on the hourly, go mark out, is in the region that we expect it to form in. So this is our measuring or breakaway gap region between 0.25 and 0.5. So far, even though I have not participated in this price run at the moment, I'm getting the signatures and price delivery using swing grading that I expected. Also, if I use this standard deviation projection, you can see how beautiful. And again, why do I choose this high and this low? As you know from my Twitter, for a daily power of 3, I use M15 standard deviations, right? So when I have these deviations forming and I get a reaccumulation in here, right? And then I get another silver bullet reaccumulation in this region with my 4th deviation mapping to this terminus, that is a very nice projection to use. Okay, so once I see this breakaway gap form on the hourly, again, I'm just monitoring price in the AM session since I did not get involved in the low risk sell region. I now see that the hallmark or the signature and price that I'm expecting is forming. And as ICT teaches, we can use breakaway gaps, right, as measuring tools in and of themselves. So although the standard deviation projection is very nice and it maps, very, very nicely to our targets, for example, this 4th deviation is essentially the low of the day, right? I now will prefer to use this breakaway gap as my standard deviation projection. So I will go from the top of the price move or the high of it to the open, right, of this breakaway gap, meaning the first candle in here that forms the breakaway gap. And on the 5-minute, you'll see it a bit clearer, right? It's going to be this high down to this low, which corresponds again to the high of the run, high of the price run, right? The origin, smart money reversal, to the open of this fair value gap, or the first candle low in this case, of this breakaway gap in the market. Okay, now that I have that, you can see just how precise these price levels become, right? And now I have these as my standard deviation tools. 2 to 2.5 lines up with my liquidity, right? And 2.5 actually forms effectively the low of the day. Again, I care more about bodies than I do about the wicks, right? The bodies here are respecting this area, forming the low of the day, right? Okay, so now I have this projection and I have this measuring breakaway gap inside of this 0.5 to 0.75. I come into the PM session with the expectation that in between this 0.5 to 0.75 and with this 2 to 2.5 deviations from my measuring gap, I will be able to find a second phase reaccumulation, i.e. the silver bullet, and I will be able to trade that as the low resistance liquidity run down to my sell side liquidity target. So in this area here is exactly where I expect to see, right, my silver bullet, otherwise known as second phase distribution. I know there's lots of terminology, so let's make sure that we understand what we're talking about. So as you can see, in this 1 hour fair value gap, which is also put inside of this inversion fair value gap, we print this H1 SIBI. And this H1 SIBI now becomes, I'm going to label it as our silver bullet inefficiency, or FVG, called our silver bullet SIBI. So this silver bullet SIBI, right? Again, I'm going to use time frame alignment and then go down to the 5 minutes and wait for a reaction here. Now, because I'm seeing all of the confluences, right, in all of these regions, this entry is ideal. Seeing the SMT form and taking this intermediate term high, right? Again, we have this intermediate high forms, right? And we're expecting to form short-term highs or we have a short-term high to the left. We're expecting to form that short-term high to the right. Now, where I actually did take my entry just because I wanted to be very safe, conservative, trading on my funded accounts, is I waited for this next short-term high to form, and I got involved in price action inside of this high probability breaker. So this becomes a breaker block. Let's make this just gray, right? And as you can see, once price trades through that and immediately wicks higher, you can be a seller inside of this formed intermediate high, inside of this breaker. We also expect this fair value gap in here, this small one, to be a breakaway gap, this fair value gap right in here, right, as it's part of this balanced price range, and we see it trade through the breaker aggressively. Again, we also have time and price on our side because we are moving into our silver bullet hour. Do you notice, right? We've yet to use the ICT silver bullet hours, but you'll notice exactly what time this high forms. And if I mark it out exactly, it's at 1:55 p.m., right? So this is at the silver bullet hour on the 5-minute chart, right? This is from 2 p.m. to, right, 3 p.m. So we'll get rid of this. And this is our silver bullet hour right in here. And you can see now we have all the confluences lining up with time and price. We're in this second phase distribution area for a low resistance liquidity run. Why is it low resistance, you might ask? Because we printed a failure swing, right? This market intentionally has created a trend line form of liquidity, LR, low resistance liquidity run conditions below. We are in this area of the swing grade or implied dealing range. We are inside the silver bullet hour, and we are inside of that silver bullet inefficiency, right? Smart money reversal, first phase reaccumulation, second phase reaccumulation. Everything is lining up with time, right at 2 p.m. So moving into that silver bullet hour, we take a trade right as soon as we get into this breaker. So we can short, for example, the open of the breaker. Stop loss is going to be above this high, right? And this is a very, very conservative stop loss. In reality, I could put my stop loss below this high here, as I wouldn't expect price to trade back up into this fair value gap. So even covering this area, just slightly above this fair value gap, I would expect this in here to be a breakaway gap, right? So that using that as our stop loss. But if you want to be very conservative, covering the intermediate term high. So let's do that. And then we want to be targeting, right, this low as our first target, right? So let's say we bought right there, or sold right there rather, and our second target can now be our 2.5 deviation, either which works. Let's see if there's any additional targets that map to this 2.5 deviation on our higher time frame chart. So let's zoom out, and we can see we have this 4-hour inefficiency in here, right? And we have the full fill level at that 2.5 deviation, right? And maybe let's go down to the hourly chart and see if there's anything more precise right at that level that we can actually map to. And I can see that we have this, right, low as well. So maybe somewhere down there could be the draw on liquidity. But again, something in that 2.5 region to offer, right? That liquidity would be the target. And as you can see, price comes directly into that low, right? So this could be your second target. I would just take it right here. And that's a fantastic trade, right? It's almost a 2-hour trade. And if you use more conservative stop loss, it's well over a 3-hour trade. But just be safe. Make it a 1.6, or maybe even just set it to be a 2-hour fixed trade, which is a fantastic high probability trade. So let's quickly break down everything we've done. All right, I have this whole annotation actually on my Twitter, and I'll link that in the description so you can go back and you can study, including the protraction profile and the buy side of the curve here, and why we reverse down, why we see a reversal down here. Hint, right? SMT, higher time frame PD array, why we see a reversal here, and then the internal dynamics here we've already discussed today. So that is how I use measuring gaps. I look for the second phase distribution inside of this area. And again, just to tie it all off, this is our LRLR, low resistance liquidity run between 0.75 and 1. As you can see, once price trades into this region, right, we get a sharp decline into our points of interest, right? You can see this is a continuous delivery from this swing grade right here down to the terminus, all one-sided, low resistance liquidity run conditions. So that's how I use swing grades, in addition to using a measuring gap, right, which we talked about as this breakaway gap, to dissect intraday, price dynamics and use market maker models in confluence with a lot of this time and price theory. So if you have any questions, please let me know. I will put some links in the description. And if you find this valuable, please consider liking, subscribing, and resharing it. Awesome, guys. Have a good one. Thanks.